Hello there. Lyonnaise de Banque, part of the Crédit Mutuel group, missed the deadline to apply for a permanent license in the UK after Brexit. However, that was a conscious decision. The UK has revoked a French bank's license to do business in the City of London after this bank decided not to apply for a post-Brexit permanent license. The CIC Lyonnaise de Banque, which is part of the Crédit Mutuel group, as I said, has missed the deadline to apply for permanent authorization in the UK. That's what the Financial Conduct Authority, or FCA, said in a statement on Wednesday. This is the first time that a company falling under the so-called temporary admission has lost that status. However, the French company said in a statement that its UK operations are already being conducted through a different arm. Crédit Mutuel and its subsidiary CIC conduct 100% of their UK operations through CIC London, its UK arm, which has had a presence in London for more than 127 years, the French lender said in an email statement. Therefore, the CIC Lyonnaise de Banque, a regional bank, decided not to renew its license applications, but that it also was necessary as part of Brexit. The authorizations regime is intended as a stopgap measure to ensure that European companies that were operating in the UK before the end of the Brexit transition period in 2020 can continue to do business. The regulator FCA said on Wednesday that if European companies have not applied for a permit by the end of the year, it will take swift action to remove permits. The Brexit trade deal between London and Brussels does also not benefit many British companies. This is the result of a survey by the British Chambers of Commerce Association, or BCC, which was published on Thursday night. Of the companies surveyed about the Trade and Cooperation Agreement, the so-called TCA, 77% said the agreement hadn't helped them increase sales or grow their business. With Brexit, it's quite a problem. In other areas too, the trade agreement, despite extensive tariff exemption, cannot eliminate the problems caused by the exit from the EU. More than half, with 56% of mostly small and medium-sized companies, said they face difficulties in adapting to the new trading rules. And almost half, with 45%, have difficulties with the regulations for trade and services. 44% stated that they had problems recruiting employees. Surprise, surprise. In addition to the problems with the trade agreement, an overwhelming majority of 80% of the approximately 1,170 companies surveyed said they had been confronted with higher import costs since the beginning of the year. More than half saw profit margins shrink, and 70% reported shortages of goods and services. Simply importing spare parts for broken machines or raw materials from the EU has become a massive, time-consuming nightmare for smaller companies, and logistical delays caused by Brexit cause massive costs when machines stand still while waiting for spare parts, said the Association of Manufacturers from the East Midlands. And BCC Secretary General Siobhan Haviland urged politicians on both sides of the channel to explore ways for freer EU-UK trade. If we don't do this now, Britain's long-term competitiveness could be seriously damaged, Haviland said. There are clear structural problems in the trade agreement that cannot be addressed before a review planned for 2026. But there are also problems that can be solved in the short term, they say. In a letter to the government in London, the association submitted 24 suggestions for improvement, including the conclusion of an additional deal with Brussels to reduce the complexity of export regulations for small and medium-sized companies. The provisions on value-added tax and visa regulations should also be simplified according to the will of the BCC. The association is also calling for the dispute over the Brexit rule for the British region of Northern Ireland to be settled. After a transition phase at the turn of the year 2020-2021, the United Kingdom finally left the EU internal market and the European Customs Union. Since then, trade between the ex-member and the EU has been regulated on the basis of the TCA. And the BCC is not asking for this for the first time, and industry is not asking for this for the first time. But any closer ties than the TCA would demand following EU rules, because the EU will protect their internal market and their customs union. And even bigger countries do that when they have closer relations with the EU. So with this government, definitely there will be no closer ties with the EU in kind of trade. And secondly, the BCC will not get what they want because of this situation. There will be no closer ties. And the Northern Ireland Protocol is the other point. Of course, there are solutions within the protocol. 80% of the checks can be reduced. The EU proposed this 1.5 years ago or something like that. But the British government does not want this. They, once again, want to have the cake and eat it, or they want to be cherry picking again, or as we would say in German, they want their extra sausage again, although sausages are a real problem in Northern Ireland from time to time. But that won't happen. The EU is a big market, and if they forgot it in London, the EU knows that they are a big market. And I'll see you in my next video. I'll be back.